Afternoon all, thanks very much. Lovely to see you all. So we'll be getting some very brave planners up on the stage now and later on, and they're going to be putting forward some fairly controversial views or some views that kind of bump up against the normal way of doing things. And so because we're all about encouraging you to think differently and challenge, we are encouraging you to submit your questions, put your hand up in the room, get involved at home. Thanks to all of those who are doing that already, and we'll try and just make it all happen in a magical, seamless conversation. So in this session, we're continuing our deep dive into the investment pillar, as is highlighted behind me, and we want to ask this one question: should advisors be investment managers? Or in other words, what role, if any, should investment management play in advice and planning firms? So in terms of who's going to discuss this with me then, we have Justine King, who is my first guest, and these are our remaining guests, but as you've kind of guessed by now, we're really trying to avoid doing things in the normal way, and we're really trying to avoid calling anything a panel. So these are the people that are going to help me discuss this question, but what we're going to do is we're going to bring each of them on in turn. They'll get a bit of time to sort of share their perspective, they'll chat amongst themselves, and then we'll open it out to the floor. So please welcome my first guest to my kind of chat show, Graham Norton-esque sofa, and that is Justine King. Right, so Justine, the question we're answering is, should advisors be investment managers?
I started in 1986 as a 16-year-old in an insurance brokerage with a small financial planning firm. Sideline, in essence, very much product-driven. And, very quickly, the 87 crash happened. And I was not involved at all in all that was going on in that department.
It wasn't your fault.
It wasn't my fault. But I was just like, wow, this is quite crazy, isn't it? Mm-hmm. And then as I progressed in my early 20s into the financial planning side, I started to, the research in those days was 24 back issues of Money Management magazine and a highlighter pen looking for the 5-star ratings. And we were dialing up into Prestel to get data, and I was phoning up M&G and buying some recovery units. That was the way we did a business. And the Aberdeen Prolific Technology Fund was just doing great guns. So I sent out a mail shot. I mean, I don't know whether you could, there's obviously, it was compliant in those days, to all our general insurance clients, and checks came in for PEPs, these personal equity plans, the precursor to ISAs, and the checks rolled in, and then, of course, the dot-com bubble burst, and all these people lost a ton of money, and I was like, well, this is nuts. Mm-hmm. How on earth did I do this? Mm-hmm. Why did I think this was a good idea? Yeah. Why? Okay. So then roll forward to the point where I started my business 15 years ago. I thought, what don't I know? Mm-hmm. Well, I don't actually know how to choose investments. I know how to financial plan, I know how to cash flow model. I was, kind of early adopter into that model and that world, but I don't know about investments. So I thought, okay, so because what I don't know, who does know? And I started reading. Mm-hmm. And of course I came across Vanguard, and I came across, the Wells Fargo guys when the index funds of the 70s. So Jack Bogle, and of course then Dimensional Fund Advisors and the academic research behind them. And I came again and I started calling up some people. I remember I called up, I think David Crozier is here in the audience. Called up David and said, can you explain this to me? And it was like, yeah, it's just all based on academic research. You just kind of, work out how much equities you want someone to be in. Diversification is the free lunch that we can have. There you go. Get on and do it. Do tax planning, do financial planning. And actually, if you get the equity, bond, cash split correct, it'll roll. So I've never bothered with the DFM model. I've just compounded. I've been an equity fan of equity zealot for the 15 years I've been in business. I'm a fan of the Nick Murray aspect of business. I went out to see him and speak in New York, and came back and went, right, 12 years ago, we're going global equity. That's what we're doing. It served me well.
And so I know from previous chats, your model will be maybe like a lot of people in the room's model, where it's kind of low cost, passive, globally diversified. Bob's your uncle kind of thing.
Yeah, I would say the DFA, the dimensional, is not quite passive. It's passive with a, you know, this is a passive in a small cap space. This is passive in a value space. It's got these profitability momentum kind of aspect to it. But the way they trade is very passive.
Okay, so if that's the kind of good but simple model, if I can call it that, is that quite hard for you or for firms who are in that space to kind of articulate the value around that? Because potentially that's something they could do themselves, arguably.
Yeah.
So how do you approach that then?
And they don't. We literally yesterday took on a new client, 2.5 million. And the email came in saying, "I'm looking for an evidence-based investment advisor," and we've taken him from 2.9% from a DFM. There was ongoing costs.
That was his total charge.
Total charges.
Yeah.
Once we worked it all out, and he's coming into us at 1.5 total cost for everything, financial planning, the whole aspect. And yeah, most people will go, the reason they're set with it is that they don't want to do it themselves. Again, it's the same old analogy. I understand in Scotland there's a lot of DIY dentistry. You know, two cans of tennis extra and an iron brew rolled in and you can pull a teeth, you know.
You can tell that joke down here, you can't tell it up north.
but in essence, there are some people who want to do it and there's some people who don't. And actually the financial planning aspect is really, really key to the whole, you know, how much cash are we going to hold to make sure that when the market falls, that we don't suffer and you can still draw down and you can still fulfill your needs.
Okay, fine. And then in terms of the argument that I hear a lot is, you know, and I think this is probably where you're coming from, is planners should stick to planning. That's where they add the value. But what about I'm a client that comes to you with that sort of Tesco bag that kind of might refer to with my paperwork and, you know, pots and policies spread everywhere. For me, that is about the investment, isn't it? It is about the pension. So how do you square those?
So we consolidate it all and put it into our investment approach.
But the focus isn't about the product. It's still in the context of planning led first.
Yes. So we do a lot of planning only, and therefore will not take on the investment management.
Yeah.
And that often is, I would suggest to them that they can research, and I can teach them about index funds, and then I suggest that they also read a couple of books. And also they could Google the largest mutual fund manager in the world and see whether they have a product available to them.
Yeah. Who may or may not have been mentioned already today. Fine. But and I guess from your point of view then, just to kind of tie a bow on it, the client's coming at it from a place where they don't care about the investments, and from your point of view, it's all about the planning, and you can kind of demonstrate to them that that's where you're adding value.
Yeah, but I wouldn't want to dismiss the investments. The investments are there for a reason, for God's sake. They're not, they're just, you know, they're very much part and parcel of a plan, aren't they? They're going to help someone achieve their goals.
Yeah.
And then there's the whole behavioural issue if they're trying to do it on their own.
Yeah.
You know, we've got to quantify that and make sure that the plan is okay. But even the people we don't take on the money for, you know, if someone wants to pick up the phone and have a consultation with me, they can just, if they've been a previous client, they can just buy an hour of my time.
And that's quite nice that the planning is almost like a module and there's no dreaded contingent, you know, you have to do this to get that.
No. And some people obviously just want you to run the thing and just go, no, I understand, you've shown me the data, I can see why this worked, you know, even in the poor years, it worked. Okay, that's fine.
Okay, perfect. All right, we'll park that for now. Thank you, Justine, glamorous guest. So I'm now going to bring up my next guest, who is Jeannie Boyle from EQ Investors, and she's going to talk about a completely different perspective about the combination, I guess, of investment and advice. So please welcome Jeannie. Hi, Jeannie. Welcome to my sofa. I'm going to get like proper like chat show vibes going on now. Right, so so you've heard Justin's view. He's kind of coming at it from the point of view as, you know, the planning is separate, investments are an underpin, but they're not the main thing for him. Whereas I think EQ Investors comes at it from a slightly different perspective. So do you want to maybe talk me through that?
Yes, the clue is in the name, really. Investment is a big part of what we're doing at EQ. We see planning and investment as going hand in hand. Having one without the other is probably unsatisfactory for most people. We have been an advice firm since the 1990s. We got involved with social and environmental investing way back in the early 2000s. We've had discretionary permissions for our clients, I think, since 2010. And over the last 5 years, we've developed a DFM service for other advisors who want to invest their clients' money sustainably. We didn't really set out deliberately to do any of this. It's just a service that's evolved along the way, and we've just seen opportunities to make our service better for our clients and to help other people access an area that's growing in demand but is complicated. I think the thing I always come back to is purpose. And we're a B Corp, so purpose is really important to us as a business. We are certified to say that we believe in stakeholder rather than shareholder capitalism, that our business exists to benefit all of its stakeholders rather than just shareholders. And that's something that we think is an important principle in investing. So our purpose we see is twofold. It's first of all to help our clients have a really lovely life through good financial planning. But we also think that you have to look beyond the individual outcome for clients sometimes and center the outcome for the rest of the world in your process as well. We can't just focus on individuals. So our second purpose is really to help people access sustainable investing and try to make our tiny corner of the world a bit of a better place through better investment management, using ESG principles and investing in companies that have impact. So I alluded to shareholder capitalism, and we think that one of the impacts of that has been this prioritization. Thank you. Of profit over other outcomes. So you may have heard the phrase private profit, social risk. So one of the impacts we see is companies not cleaning up pollution, companies not paying fair wages, companies profiting from a war in Ukraine, and the state. We collectively have to intervene to pay the costs of that. So when we're thinking about the investment decisions, many of our clients are looking for us to invest in line with their values, to stop those things happening, and to encourage companies to think beyond just making a profit. So when you start to center that kind of thinking in your investment proposition, you can't simply just go and buy a passive fund, because that just doesn't do the job. When you're buying a passive fund without any kind of thinking about where does this profit come from? My client might have a really good outcome in terms of a fantastic retirement, but how did we get there? And for us, it's essential to think that through. Is this okay? And for our clients, it's not okay. So we kind of have to bring things in-house and be close to our clients, close to their values, so we can manage investments in the way that they expect.
Okay, and I can kind of completely get that from your point of view, in that you are offering sustainable impact investing, and so it kind of makes sense that the planning piece and the investment piece would go hand in hand. But do you think that sort of extends to having a broader application, or do you think that sort of combined investment management advice piece only works when you're in a kind of particular field like sustainable investing?
I think it works particularly well in that field. I think if I'm honest, if I wasn't interested in this area, I would happily be outsourcing to Vanguard or something like that. But that's not what we're about. That's not what we do. So to be clear, none of the planners at EQ are investment managers. None of our investment managers are planners. We see them as different jobs, but we see them as being sort of happy bedfellows. And we think that clients appreciate having access to both services under one roof. The other thing we think that it allows us to do is to kind of mix and match services. So if a client just wants a plan, they can have a plan. If they just want some investments managed, we don't have to charge them a planning fee on top of that. We can facilitate that. So it's about tailoring services to clients too.
Okay, great. And then in terms of, sometimes you get this kind of, I'm going to say this wrong, but you get like a kind of master of all like trades. What's that phrase?
Jack
of all trades, masters of none. Thank you. We're helping each other out. So is there a sort of sense that if you've got advice and you've got investment management and they're under the same umbrella, is there a sort of sense that the firm will maybe dominate in one, do you think, or dominate in whether lean on one or the other? There's always going to be an inevitable strength, and therefore both services aren't being delivered equally.
No, I think it's possible for to support each other. We have a fairly, because we're working now with external advisors, we have a fairly strict separation between investment management and planning. But naturally, the improvement in one leads to improvement in others. We share ideas, we're sharing, where we have internal clients, we're sharing clients together, and I think it improves across the business. We can learn from each other.
Okay, brilliant. All right, thank you to Jeannie. And then my last and final guest for this session is Dan Williams of Morgan Williams & Co. So he's going to kind of take the kind of hybrid view. So please, Dan, come on up while I keep talking. Otherwise, I'll just do your bit for you and nobody wants that.
Fine.
So welcome to my sofa. Thanks for coming. Right, so Dan then, I think Morgan Williams has been on a bit of a journey with the investment piece and kind of how you handle it, and we'll kind of get into the heritage of the business in a second. But kind of, it would be great to kind of, while Dan is kind of formulating his answers, it would be great if you at home and you in the crowd could kind of just think about how you approach this in your own firm and get your questions into me, and I will put them to our non-panel. So Dan, in terms of your perspective, you've heard what Justine and Jeannie have said, and we'll allow you to talk to each other as well, so that's fine. But where do you stand on this? Is it a kind of, you almost need to know enough, but not too much?
I think we have to be careful that we have to recognise that we live in an imperfect world. And often we're trying to find a perfect solution to an imperfect problem, if that makes sense. There are times where, we think that passive investing for some clients is completely the right way to go. Clients in accumulation, it's trying to keep costs down and all sorts. There's also times where we think something a bit more bespoke and active can help a client. For us, it really is a hybrid approach, and because you have to have that hybrid approach, which come onto the heritage of the business, we're kind of forced to be both. We are planners, fully behind the idea of financial planning, but there are times where we have to pick funds. There are times where we have to pick, ultimately, whether it's a fund, an MPS, whatever it is, we are making a decision. If we're picking something like Life Strategy, we are picking a fund.
I should say other fund ranges are available.
Oh, sorry, I'm just picking, or HSBC, right? Or any of the others. We are picking a mandate, and maybe that includes or excludes certain aspects of the asset mix. So we have to have enough knowledge to be able to interrogate the market in the way which really benefits our clients. So I think even when we are, making those decisions, we're kind of doing it anyway, even if we don't put a hand up and say, yeah, I'm an active manager and, this is what I do, or actually, I don't do any of that, I focus on planning. Ultimately, we are making those decisions.
And I think you're quite a nice example of kind of this live discussion, actually, in terms of where the firm has started versus where it is now. So I know that when we've spoken, you've talked about how it was your dad originally, and he had a more manual process, and now kind of as the firm has modernised, you've sort of started to shift away from that. So maybe you could talk to me about that a little bit.
Okay, so I know Dad's watching at home, so hi Dad,
Hi,
nice
Dad.
to see you. So it's always quite funny because back in the 1980s, so we've been going in the current form since the 1980s, but we were kind of an amalgamation of 5 businesses back in the 70s when, funnily enough, PI was a little bit hard to come by, so people needed scale to be independent at that point. Dad was on a journey at that point, just started an advice firm. He'd left the business that he'd been at with 3 kids, or 2 kids and me on the way, and very much the old guard advice, having to go out and win business. He was also managing clients' investments. In fact, at some points he was managing broker funds, his own broker funds. He was of a generation where information was not freely available like it is now. If I want the same information as pretty much any analyst down in London, I buy a Bloomberg terminal, I pay my extortionate amount of money, but I've got access to that data. But that literally wasn't you couldn't get that at that point, not from the internet, which didn't really exist. It didn't exist. I've got a degree in computing. I should know when it exists. And he would sit there and he would manually plot the movements of funds and portfolios on a daily basis. So you'd have these big kind of, roller charts, and you'd see where things were going. This is back in the day, let's pick on another fun house, where Aviva, you come down to London and they would drive you round the properties in their portfolios and say, okay, this is this property, here's the Aviva bus tour, and this is the yield that you're getting on this property. If we kind of move into the kind of modern world where we are now, technology can do a lot of that lifting for us. We don't need to work out ratios on portfolios. The information is there. It's freely available to us. There are places where that's not the case. I'd argue, microcap emerging market, it's a lot harder to get that information when you're not on the ground or don't have someone on the ground than we are now. So as a firm, we've moved kind of away from that very traditional form of advice. Most of our clients have been with us, like most people in the room, for decades, and we've moved towards that financial planning piece. The work, trying to demonstrate to clients that actually, ultimately, if we look at kind of a client's financial plan, if we could get every single client just to hold 100% equities the whole time, then over the long term, forget like the circumstances where they're going to need the money, but just take over a very long time, they're going to do better. So why don't we do that? It's because of behaviour. And if we look at Carl Richards' book, where he says you can have the most perfect and the best built proposition and portfolio in the world, and if a client makes one bad decision in a decade, well, it may as well have been stuffed under the mattress, cash stuffed under the mattress. So we're kind of operating this hybrid world where we've got this heritage, and this causes problems in some respects because some of the products that clients hold, we can't sell them for various reasons. They don't have more modern funds availability and things like that in place. So we have to do some of that stuff, but ultimately we are driving towards pure financial planning.
Okay. Thank you. That was a very comprehensive answer. Right, so I'm going to take some questions now. I can see that there's some coming through on the streaming, and if you do want to chip in, just raise your hand and we'll get a mic to you. Jeannie, I'm going to pick on you for the first question, but it comes from Fiona, and she asks, you have discretionary permissions to deliver your strategy. How hard was this to get, and would you recommend this for people with a less niche investment strategy?
It was 2010. I remember it feeling quite hard at the time, and obviously you've got to think hard about the processes you're going to follow, whether you have the operational capacity to deal with that. Would I advise doing it? I think yes, in some ways, because it can lead to better outcomes for clients in terms of the way that you rebalance, but perhaps you need to have a certain amount of scale to be able to operate that, because of the other set of regulations that you're operating under. Suddenly you're under MiFID II and everything like that, and there's a lot of regulatory stuff that goes with it. But in terms of client outcomes, it can, I think, be much better because you don't have to worry about rebalancing individually.
Okay, great. And then we've had a question come in from Ian, who asks, do the chat show guests, he didn't use the P word, do the chat show guests agree or disagree that some advisors use a complex investment process to justify fees? Justin, what would you think about that? And then I'll come to you, Dan.
Yes.
Yes. You would like to expand your answer?
It is one of those, isn't it? If you're looking busy and the clients don't understand, it's a bit like going to the mechanic and he starts explaining all the things he's done to your car.
Oh, I don't know.
and you're like, well, just tell me how much it is and does my car work? There is that justification. And I think, so I think, my big concern with that, the amount of trading and things going on, there's a lot of people washing their hands with the same bar of soap, and eventually, by the time it gets back to the client, there's not much soap left.
Mm-hmm. Great. Dan, did you want to come in on that?
Yeah, just kind of very, very quickly. So recently brought on the clients from another firm, and effectively they had 3 different model portfolios within within their investments. All split across the same investment, so no real reason for doing it. Ultimately, the advisor was trying to look clever in our view. If we get down into the granular details, they're holding the same things in every single one of their portfolios, but they were just being charged different amounts on each segment of it. Just hold the same stuff. Sorry, that's my right. Sorry, just hold the same stuff, or within the cheapest way that you can hold it. I think a lot of people, our advisors historically, have put their value down to being able to pick funds, and I think for some firms that transition from that to saying actually no, the value I add is this is a challenge. So yeah, 100%.
Okay, great. Right, do we have any questions from the floor? If so, I will take them now. If you do, just raise your hand. Maybe you're too shy. Okay. I will keep going. I've got plenty of questions here, so that's fine. Maybe you're all just shy and putting them through the platform. So this is another one for Jeannie. So if during fact-finding a client is not bothered about ESG, do they still apply an ESG solution, or will you turn the client away?
So that's a really good question. So we apply our minimum sustainability standards across any investment that we manage. So we will never invest in tobacco, we'll never invest in arms, we'll never invest in thermal coal. There's another one as well that's got on my mind. I think it might be gambling. So if you want that in your portfolio, we are not the right place for you. We do that for two reasons. I mean, firstly, we think it's a bit wrong to profit from some of that stuff, but also we think those sectors have limited future profitability. So we think from an investment perspective, they're perhaps not the place that you want your long-term money to be held. So some clients accept that. Those who don't, yeah, we're not the right home for them. You can't serve everybody.
Okay, fair enough. And we've had a question come in from Paul, which I'll direct to you, Dan. So he asks, should advisors impose their own views on these issues, the kind of investment or planning piece, or should they simply just be a neutral foil led by a client's objectives via intelligent fact-finding? So how much is the firm bringing their own belief process to it and imposing it on the client versus it being led by the client, do you think?
I think in truth, it's impossible to fully get rid of bias. We all have bias somewhere within our process, and it's however hard we try to get rid of it, by bringing independence onto our committees or whatever it is, there is always going to be bias somewhere, whether that's a biased belief in, completely take the point of sustainability over the long term. And yes, certainly we're seeing a lot of funds move in that direction, or whether it's passive or active, I've got biases that I believe that there is value to be had in certain areas. I think it's impossible to get rid of that 100%, but I think we should always try to just work out what the client... We ask a lot of questions. We ask a lot of whats and we ask a lot of hows in the industry. A lot of the time we forget to ask why. Why is the client coming to us with that problem, rather than just what is it, what's this product, what's this, and what's the plan? It's impossible to get rid of bias, but I think we need to try to take individual clients on their merit and just work out, just take that why rather than the what or the how.
And Justine and Jeannie, do you want to come back on that at all in terms of how much of it is the firm's belief being imposed versus the client leading it?
So I always start from what don't I know, and therefore I don't know the right sector, I don't know the right fund, I don't know So therefore, and also I think all prices are representative of what they are. So let's say we buy into a stock that is diminishing because of ESG requirements. But the price will be representative of what we buy it for. So the earnings return will come from that price. So it may be a great value stock. It may be a royalty on a book that is going to be paid for the next 15 years. But we buy it really cheaply because it's good value. But it's been written in, I don't know, it was the wrong book to be written, so therefore it's not environmental, social, or whatever. But to me, it's a good value investment because of what, even though it's going to diminish in time, that will be built into the price that I'm buying it at.
Mm-hmm. And I suppose, Jeannie, from your perspective, hopefully you're not imposing your beliefs because investors are coming to you with that belief and that's why they sort you out.
Yes, I mean, that's very much it. I think, any investment philosophy, whether it's I'm just going to use passives or I'm going to go fully down the sustainability route, is a statement of belief. You have a philosophy, that's what you're recommending to your client, and they've come to you because they want to know what you think is best for them to do. And I think it's, I'm quite an opinionated person.
I like how you slightly hesitated there.
I find it difficult to work with people who don't share my values. If I'm thinking about taking on a client and I'm thinking I'm going to be working with them for 10, 20, 30 years, I think that relationship is going to work better if we're kind of on the same page about the world.
Okay, perfect. In which case then, please thank my chat show guests.